See you there. I'm Anna, otherwise known as your acid bath princess of the darkness. By now, you've already learned the definition of monetary policy and how it affects money supply, money demand, and financial assets. Today, we'll be introducing a new topic, the money multiplier. The money multiplier can be defined as the ratio of deposits to reserves in a bank. Reserve rate is defined as the amount of money the Federal Reserve, or the Fed as she's more commonly known, requires banks to hold and not lend. The reserve rate for American banks tends to hover around 10%. The money multiplier can also be defined as how much money the bank makes from deposits. Using the multiplier, you're able to determine the amount of money that will be created from each deposit, literally out of thin air hunting. Here to explain more is my main bench, Alyx, or as you may know her, Lil Cholita.
The money multiplier is calculated as the reciprocal of the reserve rate. So that's MM equals 1 over RR. Let's work it out, sis.
Say the reserve rate is 50%. To find the money multiplier, you'll put 1 over 0.5. That gives you 2. This would mean an original deposit would double in the money supply.
Now I'm really about to go in, sis.
In this example, the Federal Reserve buys $5 million worth of bonds, and the reserve rate is at its normal 10%. To find how this would change the money supply, let's find the multiplier. To do this, divide 1 by 0.1, and that gives you 10. You multiply this figure by the original investment of $5 million, which gives you a total influx of $50 million. That's a thick addition to the money supply, baby.
Hold up, pause the video, and try it yourself then.
In the words of the great Nicki Minaj, alright, I get it, let me think, I guess it's my turn. Anyways, so what happens when the Fed sells bonds? Well, that means that the money multiplier becomes negative, just like my attitude.
That's goth.
Say the Fed sells $20 million worth in bonds, and the reserve rate is 20%. That would mean that because the Fed sold bonds instead of bought, that the money multiplier would be negative 5. Multiply 20 million by negative 5, and you get what? A total reduction of $100 million in the total money supply. Problem, and this time on your own.
Alright, queens. Now back to your fave goth shorty. Let's talk about making money for literally doing nothing. It's called interest. If you didn't already know, the interest rate is the proportion of a loan that is charged to the borrower as interest. There are 2 different types of interest, nominal and real. Nominal interest rate is not adjusted for inflation. In other words, it's a fake. Real interest rate is, as you can imagine, the realist. It's adjusted for inflation. The real interest rate can be calculated by subtracting inflation from the nominal rate. So in our problem, the nominal interest rate is 5%. And the inflation rate is 7%. When we subtract 7 from 5, we get negative 2% as the real interest rate.
In this video, you learn the definition of the money multiplier and how to apply it in real-world economic problems, the definition of real and nominal interest rates and how to calculate each of them. In the next video, you'll be learning about the Phillips curve. or as I like to call it, real boring shit. That's all, folks. And don't forget, every day we stray farther from God's light.